Hi, you're watching Investor Insights, and in this video I'd like to talk about franking credits. Sometimes these things are also known as imputation credits. Now, these franking credits were introduced back in the 80s by the government to basically protect the shareholder against being double taxed. Now that is, a company makes profit and it pays taxes to the government, and then when it pays what's left as a dividend to the shareholders would be taxed again on the earnings from owning the shares. Now, this went on for a long time, but it just didn't make any sense. So they've arrived at imputation credits. And what these things are is the company that pays the taxes, well, those taxes are given to you as a credit on your investment. And when it comes to you doing your own tax return, then those credits are taken into consideration. So you actually don't get taxed twice. So let's say, for example, company XYZ pays all its earnings in the form of a dividend to all its shareholders. Now, that dividend could be, for argument's sake, $1 per share. Now, company tax is now about 25%. So the earnings of $1 per share, the company has to pay the government 25 cents as tax. So what's left is 75 cents. Now that 75 cents is given to the shareholder. Now, how this thing works is that as a shareholder, you would receive 75 cents plus 25 cents from the company as a taxation credit for the tax that they've paid. And this is taken into consideration when you do your own tax return, because depending on your level of taxation that you pay, you may find that you get more or less benefit from the franking credits. But regardless of whatever happens, you're always going to make a gain, because those franking credits are exactly what they are. They're actually a credit. So let's just take a look at a person who's on a tax threshold of 15%. So on the dollar that he or she has earned as a dividend, which consists of 75 cents as a straight dividend and 25 cents as a franking credit, he or she has to pay 15 cents in the dollar. So therefore, he or she pays the 15 cents. But because the company has already paid 25 cents, the tax department has to give you a 10-cent credit, because your tax threshold is beneath that of the company. Now, if you're on the highest tax bracket, which is, say, 42%, what that means is on the dollar that you've received, you have to pay 42 cents. Now, the company's already paid 25 cents. So all you have to pay is the last 17 cents. Now, as I said before, it doesn't matter what tax bracket you're in, but especially if you're on a lower tax bracket, the franking credits are of huge benefits to you. Franking credits are especially important for people who are income investing, or people who use the dividend yield, which may comprise the actual franking credits, as part of their stock picking methodology.